It has become quiet around the gold and silver market, and it feels like no one is interested in gold anymore. Today is a new month and thus a new update on the gold market. By the way, my name is Benjamin.
I am Hannes Hoertnagl, and 2024 is certainly one of the major years for making decisions. Years of decision at the ballot boxes, years of decision on the battlefields that are staged for us, and of course also Benjamin's decision year for gold. How does it look there? Do we have a golden year ahead of us, or will gold instead retreat?
Hannes, and these are exactly the topics we discuss in today's gold market update for February 2024. Firstly, crucial, we only have until tonight at 23.59 a promotion, which we've extended, and it's the Portfolio Management Masterclass, Master of Portfolio Management. 50% off, only until tonight. As mentioned, we'll briefly mention it. Interested in portfolio management? Treat yourself, please. 2024, we have important topics to discuss today. First, inflation during W2 and now. Is inflation coming back, or will inflation maybe disappear completely in 2024? Does this mean we might get deflation? We're talking about that. Let's take a look. No more interest in gold. We currently really feel like we have no interest in gold at all. No investors who are currently buying gold. It's getting very quiet in the media about gold. That's why we need to examine the gold market today. Also in terms of sentiment, it might be a good time to focus on it. And then, of course, the third topic again, we will look at how the further schedule is, how we currently see the courses, the course development, what further correction is possible, or whether we might even break the $2,100 mark in February, March, and start a new strong gold bull market in 2024. Hannes, inflation during World War II, yes, that's how it was back then, and that's how it will be today. This means that all that we currently see here is just a short correction, a brief calming of inflation. Many already indicate inflation may transform into deflation. Prices will further decline due to interest rate hikes, due to the liquidity shortage in the markets. But you simply must not buy this game anymore. Currently, we are in approximately the same phase of the cycle as we were during the Second World War, around the year 1943. This means we have the initial wave of inflation behind us, so to speak. With COVID, the war economy started with COVID, and then came the first inflationary surge. Now inflation is slowly still falling nicely downhill. Everything seems very, very relaxed, but just like in World War II, we currently see inflation showing a willingness to stay around 2 to 3%, only to skyrocket completely in the next 2 to 3 years. And you can already see how in the Second World War, the second wave of inflation is always the biggest. And it was like this in WW2, and it's also this wave that will really heat up the people, and also where the fear enters the markets, where the devaluation of money will increase dramatically. And then also, and I think that's the most important thing, what we can already see in advance, that then also the market development, the vertical price movements will only come with the next inflation wave. And we still have some time until it truly takes off. However, naturally, one should enter the S-classes when inflation decreases and individuals are not interested anymore. And this time, we also possess it in the gold market. Individuals are scarcely interested anymore. Gold is boring. Currently, the stock market is hot again. That's okay too, but one should precisely in such phases take a close look at the gold market. Let's now examine the crucial facts. What are the key facts for the gold market currently, and what indicates that the next wave of inflation is already imminent? Reminds me of 2020. Hannes, we did a cycle update 2 WKS ago and addressed the same topic during that update. It is very, very similar to back then with COVID in 2020, and back then inflation was already in the starting blocks. But no one really took it seriously and no one really positioned themselves for it. That is always crucial. Do people position themselves for inflation? Yes or no? Currently, from a statistical perspective, we also analyze the actions of major Wall Street banks and other analysts, but there is a lack of belief among most individuals at this time to a return of inflation as early as 2024. However, we also already have an increasing money supply in the monetary aggregates, such as the money supply. For the first time in 4 years, the money supply in the US financial system is already increasing again, and this is always the first precursor to the next wave of inflation. As I mentioned, it's solely the monetary stimulus that triggers inflation, not necessarily the rest of what occurs globally, but when money is printed, it leads to the devaluation of money in the next cycle. The Federal Reserve, the US Central Bank will make the pivot in March. We dare to hang out of the window this much now. Despite the central bank's first-time observation in this video, it is currently evening. implying an assumption that the announcement of the Federal Reserve's reversal and the lowering of interest rates will occur tonight or at the latest by March. But just now, very, very important, the so-called Bank Term Funding Program, meaning the banks saved by it, the small banks in the USA, the regional banks, still have a lifeline until the 11th March, and then the entire topic expires, and then it becomes really, really exciting. What we will also examine today is the final COVID liquidity in the financial system via the reverse repo market. It is also running straight ahead, and according to our calculations, at some point in February, the beginning of March, the whole thing will be zero, and at the latest then, it will need quantitative easing and bond purchase programs. At the latest then, unlimited quantitative easing will return. And the question we all have to ask ourselves now, here at this market update today, is how will politics sell us the new money printing? We can already observe that the stimulus is coming to an end, the excess financial reserves are vanishing, but how will she convince us about the concept of resuming money printing? Today we brought this chart, one of the most important graphs in the global macro world currently, because if this reverse repo market goes to zero and you see that this trend is about to end, then the Federal Reserve has to start quantitative easing again. Very briefly, what is this reverse repo market? This is the market where banks and central banks lend money to each other or banks borrow money, and the Fed provides liquidity. In 2021-2022, the reverse repo balance has surged as excess liquidity is withdrawn from the financial system, resulting in a significant increase beyond expectations. But since 2023 and the banking crisis at the latest, we can see that this excess liquidity is returning to the markets. So you could actually label the entire thing QE light, which is what transpired here, but just to a small degree under the guise. Fewest are currently paying attention. If this reverse repo market goes to zero, so the balance here falls to zero, and if you look at the trend here, it has been working very well for almost a year, we end up back at zero. And the question is, what are we being sold here when the reverse repo balance goes to zero? What will happen? What kind of event will come so that they want to sell us a new online purchase program again? And even if we look at the Bank Term Funding Program, currently, every week, when we update it, we have new record highs. This means that even the small regional banks in the USA still use and even use these so-called rescue lines as strongly as they did in March 2023. So nobody can sell us here that everything is okay, because also on the 11th March, this program should expire. And here again, the question arises, how will they sell it to us that this lifeline for the banks may not be phased out, but rather continued in an election year because nobody really wants to see the problems? And if we now take a closer look at the labor market, the next absolutely alarming development is that we can also see our leading indicator for unemployment figures in the USA, which is currently increasingly moving into vertical mode. This implies that temporary workers in the US are being terminated as severely as only during the COVID pandemic or in 2007 and 2008 during the major financial crisis. So there are already significant occurrences taking place in the background that should furnish us with extraordinary volatility in the markets leading up to the spring season. And if we now examine the money supply, which we just discussed, we can also observe here that the money supply is growing again for the first time since COVID 2020. Please always look down here, where the yellow line is. Why? Because above we only have the nominal money supply with $21 trillion. But if we observe the lower section and examine the change over a period of 4 months, we can observe that the money supply has already commenced rising once more since approximately 2023 during the time of the banking crisis in March under the influence of the new monetary stimulus. Consequently, the groundwork for a forthcoming inflation wave is already being laid. That's what's exciting. Now let's take another look. Now we go back to the bond market as US interest costs have officially reached the $1 trillion mark. Now it's official. This means the United States of America now officially pays more than 4% of GDP for interest costs alone. This can be compared almost to a COVID stimulus per year, only in interest costs. And if we now look at the whole thing again here, compared to the gross domestic product, we see that we currently have the same interest costs as in 1999 compared to the gross domestic product. Now many will say yes, and where's the problem? Yes, the problem lies here because in 1999, we only had 61% debt to GDP ratio, so significantly lower debt in the system. And today we have a debt to GDP ratio of 124%, which is more than twice as high. And of course, one thing is clear, interest costs at 124% debt to GDP are much harder at 4% than at 61%. And that drives the United States of America, as we have just seen, simply into the debt spiral, Hannes. And this trend is actually not sustainable.
Many Germans can sing a song about the debt spiral. Of course, many entrepreneurs, people in the real economy also see that. Benjamin, how does the whole thing continue? What is the proximity end of all this?
Yes, Hannes. Now we focus on your favorite topic, real estate, because the real estate boom, we make many videos about it, but today we have to give a little update again because the real estate boom is now over here and we have to show very up-to-date data. Currently, we have as few home sales in the USA as we did almost 30 years ago. So this is really groundbreaking here, that the speculative vehicles real estate are no longer hot, but that the speculators are also leaving this market. And if we just take a closer look and illustrate the whole thing again with this graphic, what has gold actually done compared to real estate in the last 24 years? And we see that the real estate actually down here, the real estate graph, the performance of real estate compared to 2000 to today is at 163%, but also at the same level as before COVID. Real estate has actually been moving sideways since Corona or before Corona. If we look at gold, gold is up 605% since the year 2000. And of course, when you compare it to real estate, it's like a pair of scissors that are moving apart. And here you can clearly see the real loss of wealth. And gold is clearly the winner. Will this trend become more obvious? Yes, most likely. In the next few years, it will probably fall apart like an alligator. Gold will outperform real estate market more for now. Also, an exciting graphic that I, Hannes, find one of the most exciting today on the subject of real estate, as it is the building permits in Germany. And the building permit is always the most important indicator, because if someone wants to build a house or put a property on a plot of land, they need permission from the government. And these building permits, look at what's happening here. This is a historic collapse in Germany, how the applications for permits are really collapsing. And that also means nothing else than simply the liquidity simply goes out, that simply fewer and fewer people also request building permits, that simply this market simply decreases massively. And that is, of course, a very worrying, how should I say, alarming development. But, well, I mean, we have been warning for years that this market is in a massive bubble, and of course it will come to an end here. Why German real estate boom is over? Save yourself if you can. I think that's almost the right word here. Examining performance, gold versus euro, real estate in Germany also reveals a clear trend: inflation. Inflation is often seen as beneficial for real estate, but only up to a certain point, beyond which its impact becomes less favorable. Up to a certain range, inflation is good, the sweet poison. Up to that point, it's still okay, the 2-3% mark. But when inflation shoots up to 4-7%, exactly what happened with the Ukraine-Russia war, where it becomes massively toxic, then you see real estate as a top-tier asset is not as good anymore, but gold has been performing wonderfully since. And that's why we own gold. When inflation exceeds 5-6%, when currency devaluation increases significantly, for this moment we possess gold. Real estate works 70-80 years better than gold in every cycle, but in these rare years, when things really get going in the markets, but also in politics, in geopolitics, then gold is definitely even better. And as I said, gold will continue to outperform here, and we have also come together here today. We just wanted to show you why we believe that the pressure on the real estate market will continue to exist. And here again, all the reasons at a glance. Hannes, the costs will increase significantly once more in the upcoming years. We can currently observe what is happening in the Middle Rhine East. This topic will continue to significantly impact the financial and construction industries in Europe. Interest rates will keep rising structurally. This is a trend we no longer see reversing. That means we have an exciting interest rate development, but rates will skyrocket with the next wave of inflation. And that naturally means pressure on the real estate market will unfortunately increase significantly. Real estate demand will generally decrease in the coming years, and speculative capital, a crucial factor driving the market strongly in the past, where there were many real estate speculators seeking profit, is now seeking a new asset class. They speculate elsewhere, most likely in tangible assets like raw materials, cryptocurrencies, gold, and silver. These will be the most speculative vehicles in the future, offering protection against currency devaluation. Regarding politics, property owners paying for rentals, no need to discuss. Override expropriation, we'll see. And the demographic outlook is not positive. We have an emigration from the EU of high-class workers, an immigration of not necessarily the same, how should I say, level. Let's continue, and now we move on to the next topic, no interest in gold, and possibly a good time for investors. Again, as I mentioned, sentiment indicators have it. We check the whole thing, look at it. Whenever I see something like this, I become alert because sentiment in gold market is very negative. Currently, we have few reports about gold in the media landscape, and you can measure the whole thing here. We always look at the so-called story count here. In gold, how many reports exist worldwide in all media, Reuters, Bloomberg, in the Bild newspaper, no matter where, how many articles are there about gold? And currently, for the first time ever, they have very few articles about gold in the media, as was also true before Corona. Really, where no one cares anymore. And currently, people are back in the old world and gold is no longer needed. And as I said, the stock market is booming, everything is fine, and people are no longer interested in gold. Although the gold market is trading above $2,000 per ounce and is no longer falling. And each and every person should actually give it some thought. Hey, what is actually happening here? And if we take a look at this graphic right now, one of the most intense graphs for me, because it signifies nothing else, that currently the demand for physical gold here in white on the spot market is massively high. A lot of physical gold is being bought, but the demand for paper gold, for exchange-traded funds, ETFs, that is bullion-backed ETF holdings in blue, we have a 5-year low here. That means paper gold is being sold off, disposed of, unloaded, but physical gold is being bought. And right here, we see a trend. This means that investors are shifting from paper gold to physical gold. And what does that tell us? The message from it means nothing else. We have lost trust from investors. One simply doesn't trust Wall Street, the financial system anymore. One shifts to the one and only true physical, genuine, real gold. Now, as mentioned, let's analyze. How do we see the gold market? We can say right away, we are definitely not bearish on gold like many others are. We no longer see the gold market crashing and falling sharply, but rather we see a very large base building here now to see a massive price explosion in gold in 2024 and beyond. Prime time in gold to start soon. Reason is simple. Real sins won't rise after 2024. You will experience a significant fall, but we have an inflation that is already prepared and poised to take off once again. However, the major distinction in 2022 is that the central bank will not fight inflation this year, as it is an election year. She won't oppose. Inflation will rise, won't be fought. This means real interest rate, difference between inflation and interest, diverges, you have a negative real interest rate. If that occurs, you have a gold bull market and then gold increases. Even if we now examine the entire situation from a chart technical perspective, all the fundamental drivers show that currently the gold market is still undergoing a final correction, reaching a low point in the range of 1880 to 1970. Perhaps we've hit the low point. What we mean is we're not betting on gold prices dropping here. Instead, in our opinion, the gold market has the potential to undergo a slight correction to the 1900s or even the 1880s area at worst. Subsequently, we anticipate a highly dynamic and forceful movement in the range of $2,300, $400, $500. So up to $2,500, it should actually increase very, very quickly. And by the year 2024, we have already said that we will see gold prices somewhere between at least $2,600 and $2,700. And so everything is ready for the start signal. The question is, will it be March? Will it be April? Will it be the banking crisis? Will there be any reason in the world to boost the gold market again? We naturally don't know what the reason will be, just like we didn't know what would happen with COVID in 2020. But we can clearly see that something is developing. It is simmering in the box, and it could not be better, the setup. We are no longer interested in the investors, a sentiment that is very bad and is usually at this base, which we have also seen at $2,000, a very positive signal. Even if we consider the positioning in gold, we don't have an exaggerated positioning. Instead, we have a neutral positioning. Completely neutral, not bullish now, but also not negative, so there is actually nothing to complain about in terms of positioning here. And if we now move on to the silver market, and the situation there is significantly more interesting because something happened there last week that is really worth telling you about to pass on the information here. Examine silver's price development beforehand. It's the same in silver. We reached the low in September 2022 at around $17.10. Since then, the silver market has been gradually rising. Currently, it is correcting sideways for about 6, 7, 8 months. But also here at around $23, $22.50, around $23, the base will most likely be formed, and then the increase to over $30 this year will be prepared. We see, as I said, silver at some point, at least $32, more likely $35 in 2024. Maybe the whole thing can go up much faster, but because the economy will simply boil up, the dollar will fall, inflation will go through the roof again in 2024, simply gold and silver, especially silver, but gold will outperform again, and thus a very, very positive development also in silver. But now let's examine the positioning in the silver market, and I discover that even more thrilling, because at present the speculative capital is short again in the silver market. So we really have a net short position, and that is just now. We have this wonderful green rectangle below, and historically this green rectangle has always been a very good time to take a closer look at silver. So the silver prices usually don't fall much lower when we enter this area. That also means here we see very negative sentiment in the silver market, as I said. We have net short positions. We are far, far away from any positive sentiment, and therefore one should put silver on the watch list, especially in a year where the dollar will fall, where inflation will rise again, because here very, very large price movements will most likely come our way soon. The question is always, Hannes, and that's always funny, after 3 years of correction, no one's interested in the gold market anymore, and for that reason one should look even more closely at it now, take a deep look inside, and I think we'll see a very good gold year. And most likely, Hannes, if all the fundamental data, MAR, APR, Bank Term Funding Program, reverse repo, everything points to MAR, APR. First rate cut by Fed, 20, March with central bank meeting. Something is coming our way, and I believe it won't be long before a lot of volatility enters market again.
In spring 2024, in March or April, a banking crisis will be triggered that is significantly larger than the previous one last year, and this will, of course, bring a lot of momentum back. The second point, of course, is the decoupling in many areas. You mentioned it, paper gold and physical gold. The decoupling is unprecedented, as seen in the graphs, how they diverge. And one must say, that is, of course, a phenomenon that can now be observed everywhere. Bitcoin has more or less decoupled, increasingly distancing itself from the broader stock market and many other decouplings we also see in everyday life. Markets, we have stock exchanges that reach all-time highs, and at the same time, companies, traditional companies, KDW in Germany, Rietzenhof, etc., many other traditional companies going bankrupt. Yes, we also mentioned a year ago that in 2024, we would witness the disappearance of numerous well-known companies and firms from the scene. The whole thing will likely speed up, but as I mentioned, we must examine the coupling, which is evident in every corner and aspect. And at the end of the day, I can disappoint myself, almost to say that we'll also see an impact of election results on the population from the politics that represent us and the population. And there we simply see the markets as a reflection, which are increasingly decoupled.
Yes, the decoupling everywhere. We see it at every corner and end. And that's why people be vigilant. A lot will happen. To learn more about gold and silver, visit Investing Best. Don't forget, the promotion for the Portfolio Management Masterclass expires at 11:59 p.m.
Watch videos, subscribe, ring the bell, don't miss more videos from Best and Best, and then we'll see you on Sunday for an exciting mindset video.